I had $1,000 to first start off on my investing journey, this is exactly how I would invest it. Now, I need to start off by saying this is not financial advice. I don't know anything about your situation. I'm not licensing financial advice. This is purely for educational purposes only. Okay, with that out of the way, this is how I would approach this problem. So there's three important things that we need to consider when we first start investing. And the first one is diversification. We don't want to have all of our eggs in one basket. We don't want to put all of our money into one stock, because if that company goes bankrupt, then we lose everything. So we want to spread things across to minimize our risk across the entire portfolio. The second thing that we need to consider is the return that the asset is going to give us. Now, obviously, we believe if we're going to invest in it, that it is going to give us a positive return into the future. But the hurdle rate that we need to consider is that will this asset beat inflation? So inflation usually hovers around 3, 4, maybe even 5% a year. And so we need to be investing in an asset that's going to give us at least that, so that we're keeping up with inflation. And the third consideration, which is arguably the most important, is we need to understand what we're investing in, because we don't want our decision making and particularly our emotions to be dictated by the price of the asset on any given day. Particularly in the stock market, things are quite volatile. They go up and down. The market can go into a wider downturn, and we don't want that to influence our decision making where we panic sell because the price is going down. If we understand what we're investing in, if we have conviction in what the asset is, then we should use those opportunities when the market is down to buy more, to compound our position once the market rebounds. So with these three things in mind, this is the pie chart of how I would think about spreading out my investments. So I would put $25 into something like the S&P 500 ETF, like IVV is the S&P 500 ETF that trades on the Australian Stock Exchange. So this has a super low management fee, 0.04% per year, and the S&P 500 has yielded roughly 15.3% per year over the last 10 years. That's a super awesome investment. It gives you exposure to the US stock market. There's 500 companies in it, so we're getting instant diversification inside that one ETF. So I would be putting a quarter of my portfolio into this. The next 25% I would put into the NASDAQ ETF. There's one on the Australian stock market called NDQ. The NASDAQ comprises the top 100 largest non-financial companies, so mainly tech companies like Google, Amazon, Microsoft, Apple, Meta, Nvidia, all the good ones that you hear about in the US. It's a slightly higher management fee of 0.48% for the NDQ that trades on the ASX, but it has returned an average of 19.9% over the last 10 years. And that's just because of tech has done so well in the last decade. The next 25%, I would personally be looking at investing in some kind of dividend paying ETF. So we've got some income and some cash flow coming in to balance out the growth of the S&P 500 and the NASDAQ. So some of the options would be like VHY, which is the Vanguard High Yield Dividend ETF in Australia. INCM is also the BetaShares Dividend Aristocrats, which is a globally diversified basket of dividend paying stocks. And I believe the investment criteria mandate for that is the company has to have at least paid dividends for 10 years and ideally growing their dividends over time, which is awesome. Or if you wanted a US based ETF, something like SCHD, which I think is a Charles Schwab dividend ETF, that is similar, where it has a basket of US paying dividend stocks that ideally have grown their dividend over time. So that's a solid one. Now, the last 25%, which could be a little bit controversial depending on how you invest, but I would be putting my last quarter of my portfolio into Bitcoin. Bitcoin is the perfect store of value, the hardest money on earth. I genuinely believe that one Bitcoin will trade at $1 million US sometime in the future. If you don't agree with me, go do some proper research on it before you kind of form an opinion. Go into that research with an open mind to properly understand it before dismissing it. And the reason why I think it has a place in the portfolio is that Bitcoin has returned an average annual rate of return of 62% per year over the last 5 years and 86% per year over the last 10 years. Now, I understand that's coming from a fairly low base, so that's why I've quoted the 5-year time as well, 62% over the last 5 years. I'm expecting this to kind of level out as Bitcoin matures as an asset and gets a lot bigger, maybe down to 25%, even conservatively 15% a year is still phenomenal compared to the average returns of the stock market. So in summary, we've broken up our $1,000 invested into 4 $250 chunks. We've put 3 of those 4 chunks into ETFs, which come with their own diversification across industries and geographies. And then we've also got a little bit of Bitcoin in there, which gives us some diversification in different asset class. I personally think that's an awesome portfolio to get started with. That's going to provide a little bit of volatility with some Bitcoin that might go up and down quite violently, but it's steadied out by the ETFs, and it will give you a great long-term capital growth base to then work with some small dividend payments for some cash flow as well. Let me know what you think and whether you would sub any of those out for something else.